Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. So I was reading through some questions. I keep getting questions through the website, and I can't give financial advice to anybody, but I keep getting questions on the lines of if I had 10,000 or 20,000 or $30,000, how would I deploy it? What would I do? What companies would I buy and stuff like that. And obviously, it's going to depend on each person, and I don't know necessarily your background, but I mean, I can talk in general, what my viewpoints are and what you're trying to find in the markets. And the markets are all intertwined. And the reason I look at all these different inputs um, to making decisions on where to invest, they are all interconnected. It's like one big interconnected node where the data is telling us something about the market conditions. So this is what you need to understand if you want to make a lot of money. And there's ways that I think you can make money and not even understand it. So here's a couple of things or tricks. If you're going to take a very long-term approach, you're going to literally invest in money and you're just going to let it sit in there forever. Find companies that won't get designed out, like their products won't be designed away. So food-related products, beverage-related products, insurance, banking, those types of things, they're not really going to get designed away. I mean, they could, but for the most part, there's some trends, there's some fashion trends, and maybe some people like burgers, but I'm pretty sure people are going to like burgers for the rest of their life. They need to eat something. So you can invest in these types of businesses. It's a very Warren Buffett approach where you just invest in it and you just leave it. You buy more when it's cheap and you just leave it forever. That's one type of approach. What you're doing is you're basically taking away the timing, you're taking away all that stuff, and you're just going to grow on the basically the return on equity that these guys deploy. If it's a high return on equity, maybe 15, 20%, maybe better, depending on how good the company is, how fast it's growing, and you're lucky enough to catch it kind of early in its growth phase. So it's a small cap to a mid cap to a large cap eventually throughout your lifetime. So that's one investing approach. One thing to also understand, and is another maybe different investing approach, is assets get priced differently given certain market conditions. And those market conditions are what determines the value of that asset. So for instance, I'll just make it very easy to understand. Water may be worth pretty much nothing if there's abundance of water around you. But if you're in the desert and you're thirsty as heck, what's the value of water? I'm describing two different market conditions. One, you've got water all around you. You can drink it wherever you want. Clean water, I'm saying. And you could just drink it. It's not really worth much because there's so much of an abundance of it. But if you're in the desert and you are literally dying of thirst, that's going to be a lot more valuable to you. The same thing goes for anything in markets. When oil is in a surplus, what we saw is that oil, in relationship to other assets, was completely out of favor. We could see it in the ratios. We could see that oil priced in gold went over 100 barrels to 1 ounce of gold. That is what we are trying to identify. We're trying to identify the extreme limits on the market conditions. They shut down, for the medical event, the economy, and then the oil, they couldn't necessarily slow down or stop. And we had a large surplus of oil. That was the opportunity, is when we saw, using ratios, that the value of oil was priced lower than it's ever been in history. It was an anomaly in history. And if you understand how to price assets against assets, it was quite obvious during that time frame. And what we're doing is we're trying to accurately identify what the value of assets are given certain market conditions. And what we're doing is we're basically speculating on the conditions that the market is going to change favorably for your investment. And your risk reward is the best when the ratios are blown out to the downside from an event. It could be fear. It could be, the virus with fear put in there, and that created a buying opportunity that is not really seen in the markets ever. So that is what we're looking for. It doesn't mean you're going to get it, and they happen very rarely in time. So one of the things, if you're a commodity type investor, they are cyclical by nature. What we're doing is we're basically speculating on the market conditions, saying that it's plentiful under these market conditions and it's going to get more scarce in the future. And usually what kicks that all off, usually, is an inflationary type movement where more money enters the system. More money means we've got more money in relationship to the supply of goods and services. That is inflation. By definition, that is how it works. More money comes into the system. It puts everything in a shortage because there's more money. And then the cost of those things go up in price per unit. And that is what a difference of an investor versus maybe a trader is going to look. A trader trades whatever charts in front of them. An investor looks at the market conditions and speculates on the changing of the market conditions. What I look for in the ultimate investment is a commodity company. And why commodities? Because they can change the most in the least period of time. I don't see this in tech companies. I don't see this. You can get 20, 30, 40 baggers in a couple of years. I just don't see that in tech companies that often. I'm not saying it can't happen. I just don't see it as often. And what I look for is I look for extreme fear to the downside, and then I look for changing market conditions. What came about from the stopping of the economy in oil is like a once-in-a-lifetime opportunity, in my opinion, to buy that bottom, because the markets weren't necessarily slowed down by, we'll call it, a problem in the markets. They were forcefully stopped by decision. But everything was still in momentum. The momentum was still going forward. So everything was, I think, in a pretty good situation to continue forward. They also printed a lot of money, and it was going to be very inflationary, 12 to 24 months out ahead of that. And that's kind of what we're living through right now. And when you're an investor, you have to capture those moments, because they don't have to happen often. Now, which I think, is coming up, and I'll talk about some of these different market conditions that I think are coming, is we're coming into a period where we've underinvested in commodities, in oil, in precious metals, and all of these things. This isn't a fast-moving, we'll call it, it's not a quick, get rich quick. It's not anything like that. This is like building wealth for what is potentially coming, and the returns could be quite dramatic. And what's happening is we're coming into what I think is a shortage, or an energy shortage, on top of shortages of certain commodities. And the way that these commodities are going to be priced under a plentiful area with lots of energy and lots of inventories is going to be far different than very low inventories in an energy shortage. And that's basically what we are. That's what we're going for. That's what we're taking out of the markets. We're extracting that value between the differences in the market conditions. That's what's going to make us money. Now, we can get the market conditions right, but the way that we play it, the vehicles that we choose, can also be a large determining factor of how successful we are in those investments. It's not just getting the timing right. You also have to choose the right vehicles, the right stocks, the right way to play these things. And they have different risk reward profiles. They're not all the same. So when someone says, how can, if I can have so much money, how should I deploy it? It all depends on the person and what this money is. And again, I can't give advice, but I can tell you kind of what I've done, and what I did is I identified a ridiculous setup in the beginning based off the market conditions and shutting down the economy. I thought the economy was going to come back very quick. Therefore, I thought there was some really good high risk opportunities to go into oil and natural gas. Now, why did I choose oil and natural gas over other areas? When you look at ratios and the ratio of 100 to 1 or less in oil, it means that it had the largest opportunity because we went to the largest to the downside in terms of valuations. That meant that the companies were going to pull back on their investing. They're not going to reinvest money to grow production if you've got a huge surplus. So I thought, I mean, at least this is my take on it, is we went so far to the downside that the cuts on the downside were going to be very dramatic, which is going to push us to the upside even more when that does come because of the underinvestment. Oil and natural gas also had a lot of companies that had a lot of debt, and those companies were getting pretty close to bankruptcy, which means that they were selling for pennies on the dollar because there was a possibility that they could go bankrupt. That was another setup that you don't see very often, and they usually happen at the complete bottom of a market. And so we saw companies with high debt. We saw this weird anomaly in terms of the oil to gold ratio and oil price against anything ratio. And then I thought we could come back pretty quick because the markets weren't underlying, weak. They were strong in an expansionary phase of real estate. So I thought they'd come back real quick. Oil and natural gas also, there was a bunch of companies that got sold off, but they had infrastructure in place. So the infrastructure was there. They were just a high debt company. What that means is that through the money printing that they did in 2020, that inflation was going to erode the debts away through the price of oil. So what I did is I took those bets because they had infrastructure in place. I thought they could be complete cash cows later on. And I thought that the oil price would go up further to the upside because of the problems that we had to the downside. They were going to cut back all of that spending on oil, the production. So I thought that the setup was really good. Now, I know a lot of people are asking me, well, is that setup still good? I still think natural gas is incredible. It is an incredible deal in America, and I'll just say in North America in general, versus Europe and Asia and the natural gas pricing and the arbitrage between them. That arbitrage still exists. It's still a really good investment deal. I still think that it's going to work. That's why I don't sell. I just hold on. I've been holding on since 2020. It's been over 2 years now. And why would I sell if there's nothing better that I can get into? So looking forward, there's going to be different opportunities that are coming up as the market conditions change. We know that there's extreme, we'll call it problems in Europe and Asia in terms of their energy prices. What that's going to do is that's going to set different operating conditions under companies in those countries versus the operating conditions and costs in the countries that are here in America. What are the most energy intensive areas? Smelters. Well, there's probably going to be an opportunity of investment in aluminum smelting, zinc smelting, and basically smelters. And if they shut down in Europe and they shut down in these other areas that are very expensive, well, what do you think is going to happen to all that market share that's going to move towards, let's say, lower cost areas where these smelters operate? I think there's just going to be a big divergence there. And I'm not saying that I'm going to dump all my money in this. I'm just saying that that's the types of things that I look for in the differences. And that is some of the things that we look at the Finding Value website below Platinum membership in the companies that I'm trying to research. I'm trying to find how this is all playing out and where are opportunities to invest based off of the market conditions around the world. And if you notice, I'm strategically picking off fertilizer companies and natural gas companies in certain areas that are small cap companies that have the ability to continually to grow over the next 10 years. Those, I think, will be some of the most valuable things. And they're in countries that I still think that can export their natural gas or oil or whatever it is. And if things start to deteriorate across, over in Asia, they go to war with Taiwan whatever it is, and we put sanctions on China, whatever it is, the companies that I'm in will become more valuable because we're going to get less from that area. So I'm kind of, what I'm doing is I'm playing chess 3, 4, 5, 6 years ahead of us, or even up to a decade plus. I'm trying to find what the market conditions and the differences are between today and out 5, 10 years. And I know a lot of people, they want to put a lot of money in uranium and these small uranium companies. There is risk there. There is risk. And what the risk is, they don't have infrastructure in place. They aren't going to be a cash cow. They don't have the mine built. A lot of these companies, you are speculating that money flows will come in ever greater quantities into these companies. And I have those companies too. And I'm speculating that some might be bought out by certain countries or other companies. And that can be very profitable if it works out that way for you. But sometimes it doesn't. Sometimes it doesn't work out. So I tend to prefer companies that have infrastructure in place. They might have large debt that brought them all the way down to the depths of a very low valuation, and maybe even on the brink of bankruptcy. And what I do is I play a super leverage bet to the price of the commodity. That's really what I'm doing. It's a super leverage bet to the price of the commodity. And some of these companies that don't have any infrastructure in place, they're a lot riskier because you may never get the cash flow out of them. That mine never be, it might never be built. Maybe that's the whole purpose of the investment, is you're just speculating, you're hoping for a big move higher based off of money flows, and that's it. And that's one of the large things that I look for, are the differing market conditions. That is constantly what I'm looking at. Differing market conditions can be inflation versus big inflation versus small inflation. A declining interest rate environment versus an increasing interest rate environment. And those are the big drivers. Then you've got your market conditions of the actual sectors that you want to go into. Is it in a market surplus or a deficit? Are we adding to inventory or eating through inventory? And what kind of conditions out in the future could impact those inventories? If a shortage over here may impact this commodity over here, which will create another shortage. Those are all the things that I'm looking at and trying to base my investments on. So if you're short in natural gas, a substitute is coal. If you're short on coal and natural gas, a substitute is oil. And if you're short on all of them, a substitute could be turning back on nuclear. And I'm playing that entire kind of mix. If energy goes short, then you're going to have problems with fertilizers. If energy is a strong input for making fertilizers or natural gas, Europe's going to have a problem competing with low natural gas areas. So I'm going to put my money in those low natural gas areas that makes fertilizers, aka America and Canada. So that's kind of the things I look for when I invest. And it's going to be different for everybody. If I was a young guy, 20-something years old, just coming out of college, save some money, maybe I've been working for a couple of years, maybe I'm paying a ridiculous amount of rent. Maybe I buy a house and rent out the other rooms to my friends, and they pay the house off, with myself. That's one strategy. Doesn't mean it's right, doesn't mean it's wrong. Another strategy could be to swing for the fence with some of the money. Swing for the fence, do some uranium exploration companies, and really swing for it. Other things could be doing physical precious metals and ratio swapping. I think that's a pretty low risk bet, and I think it works pretty well over time. In all honesty, all of my investments are really just ratio bets. It's buying when the ratios are cheap of whatever that asset is, and then swapping it when it becomes expensive to something else that's cheap. And the market conditions are more or less determining the pricing of those assets. And you can use ratios to determine what the market conditions are and how they're changing against each other. When platinum outperforms gold, we're in an inflationary environment. When it's not, or when it's going sideways, people could be scared. They could be determining, maybe we have a recession before we have the inflationary boom. Then you look at, certain commodities and their supply demand characteristics. All of those things have factors. If I have something that could potentially be short in the future with declining supply, and we've got a surplus today, and I'm a long-term investor, that's what I want to see. And the ratios are telling me that this particular commodity is super cheap. That is what I look for. It's exactly what I look for, and I pile into it. I view investments over 5, 10 plus years. I'm fine with accumulating for 4 or 5 years. It doesn't bother me. And I'm not here to try to, quote, make money. I'm here to protect wealth and grow wealth and look at assets as a store of value. That's different than me trying to make a quick buck. I'm looking out there saying, where can I store my wealth? And what are the risks associated with that store of value? And I think that's just a different viewpoint than maybe some other people take. They want to trade. They want to get in things. They think that action is making them money. And what I found is the more action you take, the less money you make. That's what I found in my personal experience. And most people think that they're trying to make more money. I just look back and say, well, if I just bought this and sat in it, I would make more money. If I had basically just bought things and sold nothing, I'd probably be richer. Even Warren Buffett said that. And I think that's probably true. If you buy a place, just accumulate assets, accumulate homes, accumulate cars, accumulate whatever, collector's cars. I'm not talking about regular cars. But, you just start to collect things and all of a sudden they just keep going up in price because, they don't make special model cars anymore. They don't make, the price of new homes continue to increase because of the labor costs and material costs and the energy costs associated with it as energy goes up. It's just everything gets more expensive. You just have to figure out the timing of when to buy this stuff. And I think that's what I'm, pretty good at, is figuring out the timing to buy this stuff using ratios. And yeah, I get it, guys. I know a lot of people want to do trading. I don't know that many people who've been successful at doing it. So the approach that I've taken is, if I don't know where the market is necessarily going to go, which I don't think anyone knows that for sure, what I try to do is I try to discern what is a fact in the market. It's a fact that this is cheap over here, so I buy that. It's a fact that this is cheap. I buy these things in my portfolio when they're cheap. I'm speculating on the market conditions changing, and then I just sit on it. That is what investing is all about. And then you have to look at your risks and how you manage your risks. So that's what I do. If you guys are interested in trying to learn all this stuff, obviously I use technical analysis. I use other things as well to try to time my purchases and to ensure that the market conditions are still changing favorably for the investments. But if that interests you, description link below, platinum membership, that'll get you there. If you guys, like this content and want to keep watching me, thumb up, and then also subscribe to the channel. So we'll talk to you later, guys. That's all I've got. We'll see you next time. This is Finding Value.